Echoing the 2000 boom to crash cycle, we're looking at the similarities to learn from the past and how to apply that knowledge in the markets today, especially for trading shares in this heightened volatility. There are 4 stocks building bases to cover and watch it for the next breakout that Gary Glover from Novus Capital will walk us through. Good morning, Gary. How are you?
Yeah, I'm great, Chris.
Now, you've mentioned for quite some time now how similar this market cycle is to that of the 2000 through to 2003 bear market, especially the NASDAQ, that many people remember as a terrible market phase. What's the similarities that we're learning from that cycle in the market now?
Yeah, look, I kind of might sound funny here, but this might be one of the more important lessons that I cover here this year. I think this really, we just sort of seem, I think, like, so many similarities. So obviously you've got excessive valuations there. So you've got the type of fundamental measures that you're sort of seeing at major highs there, just sort of like these, maybe 30, 40 year type excessive valuations there. You've also got prices that's tipped over here. So all of a sudden the trend, after running pretty strong here, has basically overbalanced. So what that means is sort of the largest correction of the trend is sort of tipped over. And then we've also got an interest rate sort of tightening cycle on our doorstep as well here. So just so many similarities here with 2000 there. So that 2000 obviously was tech rally, really big valuations there. We saw the interest rate cycle sort of kick into gear there, and then we saw an overbalance of that trend there. So the only thing I sort of noticed is that the only sort of real difference I've noticed so far is that the NASDAQ, which was sort of one of the, the tech wreck or the NASDAQ sort of boom there was quite a large one. It had a very large correction as well. So I think it had like a 40% drop in the first few months, and then end up 2 years or 2 to 2.5 years later, sort of down 80%. So that was pretty big move. So far, we've sort of only dropped about half. I think we're down about 22.5% the first few months. So that's probably, I think we sort of spoke last time about, generally the first few months, that sort of fall there. If we sort of double that, that's kind of where we sort of end up in like a lot of the occasions there. So if we, as a sort of rule of thumb there, it's probably, the good news there is that we're not going to get an 8% fall like 2000. We might just sort of, if the first leg's down, say 22.5, maybe we'll end up with a 40 or 45, 50% sort of move down. That's probably going to be the size of the leg down. Probably won't go any further than that. So that's the good news, is it won't be as brutal as that market there, but definitely some similarities there. The thing that really is striking there is look at the chart of the NASDAQ 2000, 2002 is look at those bear market rallies. Look how short, look how sharp those moves are, and there's quite a few of them. So really, it's quite a few bounces sort of in there. Really sort of really volatile markets. Really bounce back right deep into the range there. I mean, some of those moves have probably come back beyond the 50% mark, probably almost come back 61.8% of the range. So really deep back into the range there. So just continue to set up sort of lower half to lower high, but really short, sharp rallies there to try and, So I think it just tells us there we're going to see some pretty volatile markets, which we're already seeing. And we're going to see some really sharp bear market rallies, which we're already starting to see as well. So, just probably not going to be the same sort of size as the move there. So, if we look at the sort of current move, we're already sort of starting to see this similar type of move here. As we mentioned last week there, don't be sort of surprised that some of these bear market rallies can be a bit larger than some of the other moves. So, just don't underestimate how much these bounces, they can be quite powerful.
So powerful rallies happening then and also now. So that's a parallel that we've got in the current market cycle.
Yeah.
The S&P500, when you have a look at that, 2002 to 2002, I should say, you've highlighted these red pockets. Are they the similar sort of bear market rallies that were happening in the S&P at the same time?
That's right, yeah. So again, super volatile period. really sort of sharp bounces off the lows and stuff there. So really got it's really got a series of lower highs, setting up here, and there's some really powerful rallies and some bounces in those, in those moves as well. So again, here we had like a 30% drop there within the first year, and then ultimately went on to be only down 50%. But it just kind of gives us a guide there early as to sort of maybe the size of the move's not going to be, it just gives us an indication of sort of what the sort of final move might be there. But yeah, again, just a lot of similarities in terms of how we're trading so far. The S&P, didn't fall as much as the NASDAQ, which is the case here already. So NASDAQ's off 22.5%. I think the S&P's off only about 14% so far. So we haven't come off as much as the NASDAQ index. So expect that to be sort of similar here. So just a lot of similarities here. Still think we can have a few bounces up there. Just we've seen in the past there how some of those bounces have bounced really well back into the range, and it's been the one interesting observation is most of those bounces there's like a little three-way structure. And you see we've got a little three-way structure in October, a little three-way structure there in sort of December in 2000, even in sort of July 2000 as well. There's like a little three-way structure on the way up there. So we generally sort of see these sort of like ABC rallies there. So even off the low, they're a little three-way structure as well. So most of those bounces there, they're short and sharp. They generally have a little three-way structure. And that's the type of thing we're probably looking for. We're looking for a little three-way structure bounce here. So every time we sort of see something, a little three-way structure, I think it bounces, deep up in the range, so midpoint or maybe up to the 61.8. That's probably what we should be looking for there, as in terms of maybe putting some more sort of snags or B-bus on.
Okay, so that's a good use of the history in both the S&P 500 and the NASDAQ, understanding that sort of behaviour, the sharp rallies, the three-wave structures to indicate where to position another trade, and using that in today's market. What about the Australian market? You've said many times that it fared better in 2000 and 2002. Are we following a similar playbook?
Yeah, so it's quite amazing there, really, because you think that NASDAQ off 80, S&P off 50, and I think I think ultimately we only ended up about 15%. From that sort of same NASDAQ top there. You sort of see there that when the NASDAQ top there, obviously we had like 11.4% drop, which we've had exactly the same number recently on our market, which is kind of eerie. But then we actually, while the NASDAQ made lower highs, we actually bounced to a slight new high. But then we sort of come back in the range and go to a new high again, back in the range. So real volatility there. But on quite a few occasions here, we've actually expanded to slight new highs. So actually the index went to a new high there on, I think it was at 1, 2, 3 occasions throughout that bear market. So our market definitely, in the past has shown relative strength compared to the other US indices, particularly those growth indices. So being more of a value market when the money's exiting growth, it's looking for value. So our market has held up there. The one thing you can see there is, you're down 11, up 16, down 6, up 6, down 6, up 6, down 7, up 11, down 17, up 21, down 23. So that 2-year period, there was really some volatile moves there and some real, up and down moves. So just already starting to sort of see that, Chris, as well. So I guess what this is sort of saying to us is that this could be a really volatile period ahead for the next sort of 12 to 18 months here. And we've followed a very similar path already to what happened in 2000, and we've already come up by sort of same amount, same sort of looking type of sort of structure there, but really, really volatile. So can't get as bearish about Aussie equities as I am US equities. In the past there, we've sort of showed relative strength in those, when high growth has been crunched. So, but it is going to be volatile there. I think there'll be opportunities there. So I think anytime the exchange gets really hit hard there, we should be sort of trying to buy some quality there. But again, with such volatile markets there, we talked about this, you and I recently, about there's definitely some stocks, some sectors that are running hot, others aren't. Even within some sectors, some stocks within one sector are lagging. Some are running hot as well. So it is a real traders market here. There's definitely opportunities there. Just probably going to be a bit more volatile. So maybe our sort of our trading time might be more shorter, orientated there. So instead of trying to capture 30-40% moves there, maybe you should be looking for say 15-20% moves on that. So with a tighter sort of risk reward sort of structure there.
Right, so keeping that capital nice and preserved in the bear market cycle, and happy to take the profits instead of going for the multiples.
Yeah.
When you're looking at the Aussie market, you've said that there are some leaders and there's been consistently parts and cycles leading while other parts have been coming in and out of favour, and that's partly reflected in that sideways churn of the Aussie index. You've highlighted 4 companies this week that have some sort of base building or potential. So if we start off with Air New Zealand, why is that one catching your eye?
Yeah, just a sort of sideways structure there. So it sort of had a bit of a, I guess you call it impulsive rally off the lows, and then really we've sort of gone sideways for the last year. So it's a really sort of tightening pattern there, sort of overlapping in nature, and come back down to the bottom of the range here. So it's probably sort of at year lows here. So I quite like the Air New Zealand there. It's sort of unlike a lot of those travel stocks there, they haven't really gone to market and raised a bucket load of equity. I think the government owns about 52% of the business there, the government super fund there, and so I think they've sort of they've lent a bit of money in the government there, so haven't had to sort of do an equity raise there. There is a chance they might do that, go to the market and raise some equity, but oftentimes they're sort of done near the lows anyway. So any equity raise here might be a good opportunity for them, but can't see. I just think we're all starting to come out the other side of COVID here, and travel restrictions are getting lightened here. So just think this looks like a recovery play to me. I think it's share price they haven't done an equity. So unlike a Webjet or Flight Centre, Qantas, where there's a lot more shares an issue. There's not that issue here. But obviously it's been a tough time for the last couple of years. But I just think this looks pretty interesting here. Sort of nice little tightening pattern here. Bit of volume the last couple of weeks here. I think if it can kind of bounce from here, getting it moving, I think that's sort of one to keep an eye on there. So even some sort of equity raising there might be a good thing for this one.
So that's one with a tight coil, and you're looking at with a false break.
Yeah.
Lease has been slightly more volatile over that period, but still coming down. And in the last 6 months or so, it's really tightened up, but started to break out of that tightening period. How do you see a trade coming out of Lease?
Yeah, similar sort of there. I mean, it's just really, again, the whole thing is overlapping. So it's not like an impulsive or a really, not going down fast there. It's been a bit of a slow decline here. So it's just overlapping in nature. And more recently, the price has really coiled up, really, really tightened up. The volumes sort of, into that sort of low were pretty light as well. So it wasn't too much. But the last probably, 4 or 5 weeks here, we're starting to see recovery. We're starting to see some volume coming in. So really starting to sort of see, looks like accumulation sort of style volume to me. I'm just sort of poking its head above that range as well. So I think this looks pretty interesting here. This looks like it's, sort of coming out of a really long serving congestion pattern there. So I think that looks pretty looks reasonably positive to me.
So good trade there on Lease to come. A2 Milk, you've traded this successfully quite a few times. You've got some good quick rallies out of it and some good profits. How do you see A2 behaving at the moment?
Yeah, look, it's got that sort of false break at the low recently. Had a bit of a rally there, but not really. It's had a decent move, but without lighting it up. And then now we've sort of pulled back and consolidate again, almost like got a high low in place again. Just sort of starting to sort of push up again. So to me, it's starting to have that appearance of a bit of a base here. So it's starting to flatline. So after having a really downward, really long serving downtrend, it's sort of been basing here for a while. So just, I think this is sort of constructive here. Just a few signs there look sort of positive to me. Not without some risk here. I know milk's in a commodity space there, but it's still a reasonable multiple, A2 Milk. And obviously got its China risk and stuff there, but yeah, it just seems to be sort of basing here. So it's just sort of one to keep an eye on here. I'd again, anything like this, I'd just keep the sort of stop sort of tight here. But I think at some point here, this is going to get, it's either going to resolve itself in one or two ways, sort of breaking up and out of that range, or continue the downtrend there. So I think eventually it's going to be a bigger move out of this consolidation there. And so far, I think it kind of looks more constructive than negative there to me. So similar to that, Synlait as well, same sort of sector there. So again, strong downtrend. We've sort of bounced out of that downtrend. Now we're starting to build a bit of a base, a little false break, a little sideways congestion pattern there. Volumes are pretty light here, sort of through that period. A little bit of accumulation off the low, a little false break here, but yeah, just starting to see some positivity there. But again, pretty early. You want to be pretty tight on these ones. But yeah, just both look like sort of base building structures to me. So yeah.
They're the ones to watch out, though, the base building, because that's where you get the best risk reward opportunities, is it?
Yeah, look, it's all, like in this market here, I think we sort of talked about it, I think things are moving once they get going. So I think you just need to have, I just think, good risk reward there. You don't want to have any sort of 2-for-1 sort of trades here. I think you want to be aiming a bit higher. So, in a market which is moving pretty aggressively, if you've got 3-for-1 or 5-for-1 risk reward, you don't need to pick too many winners to sort of have a winning edge. So I'll just be trying to keep things pretty tight in that regard. But I think there's volatility. Is as we've seen in the past, these type of markets, super volatile markets in the past. I see so many similarities between that period now. I just think it's going to be quite similar.
Well, you have been calling it some time, and it's been playing out to that over the last few months. So they're the insights. And to the questions that we've had over the last couple of weeks of how to get in contact with Gary or how to get a copy of this report that we're running through, you can grab Gary's contact details on the screen there. Email and phone number, are they the best ways, Gary?
They can reach out to me by email or phone anytime.
Very good. Well, thank you again for walking us through, and we'll talk again soon.